Welcome student. In this session on the paper Advanced Financial Management, ICAI Ashish Gupta, Joint Director Board of Studies, welcomes you all in this live virtual classes. Now student, in the previous two classes, we have covered the chapter number 1 and chapter number 2. Now in today's session, we shall start with the chapter number 3. And today with us, we have CA Jagbandhu Padiji. I think the student who have attended our live virtual classes for intermediate in previous session must have attended their session as well. Now today we are starting with him, and student in this he will discuss the assignment with you. Of course, he will also briefly discuss what are the various concepts with you. Student, in case you have any query, you are free to ask by sending them to your query handle, or after in the end of session we shall open the session for Zoom. Okay, so the student can even ask query in a verbal mode as well. Okay, Jagbandhu sir, we welcome you. Thank you for sparing your precious time and taking the class on this topic. So now the session is hand it over to you. Thank you, sir.
Thank you, C. Ashish Gupta ji, for the kind introduction. Good morning, everyone. Good morning, my dear students. Very good morning. You can see a lot of students are already online in this wonderful morning of Monday to get an insights into a really interesting topic, which is advanced capital budgeting. I'm pretty sure that all of you will be, quite remembering the topic of capital budgeting or investment decisions that we had in CA Inter. So there we might have learned already the net present value calculation. We might have learned the IRR calculation, payback period, discounted payback period, modified internal rate of return. So these are some of the topics that you might have already, get yourself acquainted to during the, intermediate studies. And I presume that you are sort of, getting connected to how to calculate the present value, how to get the net present value, how to calculate the IRR, right? Those are the basic stuff which a professional like you and me should be really aware of, because that's something which we use in our day-to-day life for decision making, right? So we are being a finance profession, being into the finance profession, we would never like to take any finance decision without proper calculations, right? And this topic of capital budgeting, followed by advanced capital budgeting that we are learning today, is a handheld tool for us to make any sort of financial decision, right? Just to give you an anecdote, I'm like, whenever I'm buying any asset, for example, a car or maybe a house property or maybe even a refrigerator for my house, we generally undertake this sort of thing in our mind, right? But it's just not that we are not, putting it in black and white, but the calculation definitely goes into our inside our mind. So this is very much a practical topic that we are going to discuss with the basics already clear, right? Because and that's therefore we are all into the CA final, right? So basics are clear. Now we are going to take it to the next level of advancement in the form of advanced capital budget. Before I go directly into the chapter, what I do is generally I just give you an overview of what all are we going to learn in this chapter, and then definitely we'll take up the points for discussion. Now, first thing, we had a chapter called as risk analysis and capital budgeting in the old syllabus of CA Inter. So certain students might feel that since that chapter has been removed from Inter, now is it going to be there in the final in the form of advanced capital budgeting? At the very first instance, I want to clarify that it's not that. Okay, so maybe that part is just a 15 or 20% of what we have in the CA final syllabus for advanced capital budgeting. This is going to be something really more inclusive and more widespread topic that we are going to look at right now. Okay. So what do we really have in this advanced capital budgeting? Sometimes, when we teach the CA intermediate students, or the students when they're teaching students the capital budgeting for the first time, the general query is, sir, you said that we estimate the cash flows, then we discount it. We understood that discount rate can be the cost of capital, right? Am I right, everyone? I hope you can recall that the rate at which we discount our cash flows is should be generally our cost of capital, correct? So that's okay. We can calculate the cost of capital using the techniques, IRR technique, or the simpler techniques of cost of capital. Uh, but when it comes to forecasting the cash flows, how do we really forecast that cash flows are going to be really certain, right? Because what is the surety, or what is the accuracy level of our forecasting? That is something that the students ask us. So you said that in the first year cash flow will be 15,000. Can't this cash flow be subject to any change, right? So these questions, or some sort of ifs and buts that we had at CA interlevel for advanced for the capital budgeting chapter, that's going to be answered over here. Okay, so let me just give you a brief overview first. What is the point of our discussion right now, or what are the subtopics that we are going to look at uh, in this particular topic? Now, in this advanced capital budgeting, the first point of our discussion, it's going to be impact of inflation on capital budgeting decision, right? These are the impact of inflation on the capital budgeting decisions. Okay. One common question which I encounter when I teach students capital budgeting for the first time is, sir, even a layman, even a maybe a 11th standard student also understands that there is inflation in the prices of the commodities. Okay, so you said that cash flows are forecasted, right? For example, we generally write the pattern of cash flows. You said that zeroth year you're going to invest, let's say, a lakh rupees in a project, right? Then first year, second year, third year, you're saying that there will be cash inflow of 30,000, 40,000, and 50,000, right? So students really generally ask me, sir, is this cash flows including the inflation effect, or is it the cash flow at the current prices, right? That's such question which generally some of the students have in their mind that, sir, okay, whatever you're forecasting these numbers, these are these at current prices, or are these the prices that are that's going to prevail at that time? And generally we have some questions where the number of units are given which are going to be sold, but the price is fixed. Then again the question comes, students from the students and, sir, how can you say that the price will be constant for all the next 5 years? Are we not going to look at the impact of inflation? Because you said in first year the product will be sold for 100 rupees. So what about the price of the product in the second year? Is it still going to be 100 rupees? Why are we considering the inflation in the prices? So now that is what we are going to consider over here. The impact of inflation when we are doing the capital budgeting decisions. There, how do we take inflation into account when we are going to calculate the present value of the cash? Okay, so that's the first part of our discussion. So we are going to bring in inflation. We are going to learn something called as nominal cash flow and nominal rate. We are going to learn something called as real cash flow and real rate of discount. Okay. So that is something which we are really going to focus on. That's something which we are really going to look at. How do we involve those things into our decision making, right? So impact of inflation. How are we going to adjust the prices according to inflation? If the prices are already adjusted according to the inflation, how do we take the present value of it, right? So we'll learn something, as I said, real and nominal cash flows and the discount rate. Really interesting topic, guys. Much more insights coming up for this aspect. Okay, that is one thing. Second, that we are really going to learn in this topic of ours, advanced capital budgeting, is getting the impact of risk into our projects. Or I can say certain impact, like how do we measure the risk that we have in a project? Okay, so we are going to uh, see the risks in projects, right? So risk in capital projects is what we are going to look at. Now, how do we really deal with the risk, and what is the measure, what's the technique that we use, right? Because it's a well-known and settled fact about finance, guys, that uh, high risk, high return. Am I right, everyone? Correct, everyone? High risk, high return. I hope you all are pretty sure about this basic fundamental of finance. Right? I would like to interact with the students. I don't want it to be a one way, right? So I want our students to be really interacting in the chat boxes. Right? That really motivates me. So Sahil, Nisha, Stephen, Nilay, Monica, I hope you all are there. Good morning. Yes. Okay. Okay. Good morning, everyone. I just want the interaction from your end. Okay. So I was asking you a question that uh, we all are aware of the fundamental high risk and high return, correct? Right. So if a project has got higher risk, we would like to we would like to get more information about how risky the project is, and for that level of risk, what should be the rate of discounting that I should. Right. So risk in capital budgeting, we are going to see uh, how do we take this risk analysis in the capital projects. Okay. So there are certain statistical tools that we are going to use, right? So some of the statistical tools that we are going to learn in this topic, you already are aware of the statistical tools, but basically we haven't yet applied. So in the foundation course, you might have learned something called as probability, standard deviation, variation, or some sort of coefficient of variation. So all those aspects are actually going to be applied in our topic of advanced capital budgeting to measure the risk. We're going to use probability, we're going to use variance and the standard deviation, right? Uh, then, of course, we are going to learn something called as coefficient of variation. Now, some of you, when I teach this to the students, they are like, sir, we thought it was over at foundation, right? So many students thought that, sir, this was over, enough of statistics. Now we don't need to encounter statistics in our life anytime more. But now you are seeing that probability, variance, the standard deviation, coefficient of variation. So these topics you are bringing up right now. Yes, guys, I'm going to touch upon these topics to understand the risk in a capital project, because these are really insightful techniques which help us measure the risk of a project. But trust me, guys, we are going to understand these topics with more practical orientation in our field, right? Because at your school level or your junior college level or at foundation level, you might have learned this capital budgeting. Sorry, we might have learned this tools of probability variance with regards to only, some random examples, which some of the students may not be able to connect, sir, why are we studying this for finance? But that those concepts are going to be applied now practically in this topic when we are going to measure the risk that is involved in the capital projects. Okay. So trust me, guys, we're going to understand the real application of these techniques. Then there are certain conventional tools that we are going to cover up. Right? So some of the conventional techniques that we'll be covering in the chapter of advanced capital budgeting. It's been like, since ages, these techniques have established and they follow the simple rule: high risk, high return. Even a layman would understand if an investment involves a higher risk, I expect a higher return from that. And therefore, this concept has been since ages where we are going to compute the risk adjusted discount rate. How do we adjust our discounting rate according to the risk in a project, right? And then, of course, we are going to learn something called as certainty equivalent. See, cash flows of any project are, definitely subject to some sort of risk, right? And when we write down the cash flows as years and the cash flows amount, what we generally have is, we write down the year and the cash flows. The cash flows are your expected cash flows. Those cash flows are not your, sure or a certain cash flows, right? But a portion of that cash flow will be, certain. Like, for example, if I say next year I'm expecting a cash flow of 10,000. If my immediate question is, if this is your expected cash flow, can you tell me what is the certain amount of cash flow out of 10,000? So if your 10,000 is your expected cash flow, then what proportion of your cash flow is sure? What proportion of your cash flow is sure? That's what we are going to look at in the certainty equivalent, where we are going to identify what portion of our assets are certain or sure. And then, of course, I'll just ask a question. If I know that a certain cash flow is certain, or a portion of a cash flow is certain, can you tell me what should be the rate of discounting? This is very much premature to ask you, but I just want to get you involved. Can you tell me if, let's say, the cash flow is, 10,000, and I say that out of this 10,000, with surety, we can say 4,000 is something we will receive bare minimum. Sir. Nothing doing. Surely we are going to get this 4,000. Can you tell me what should be the rate that I should use to discount this sure cash flow? Should I use the cost of capital? Should I use the cost of equity? Or should I use the risk-free rate? If this cash flows are 100% sure, I'm going to receive this cash flow. Should it be a risk-free rate or should it be a cost of capital? Yeah, guys, tell me. What should be the rate at which I should discount this 4,000? This is sure shot, 100% sure that I'm going to get this. Okay, okay. You can see some of the students are answering. This 4,000 will be discounted using risk-free rate, guys, because these cash flows are sure. This cash flow is sure. 100% surety that this is going to be arrived. But yes, if we are using 10,000 as a cash flow, then I cannot use the risk-free rate, right? So that's another concept of certainty equivalent that we are going to discuss further in our subsequent classes. So cash flows and certain cash flows or certainty equivalent is something, the technique that we are going to use. Okay. Then some of the other techniques that we have to understand the risk or to measure the risk in a typical project, something called as sensitivity analysis. Right? Sensitivity analysis, because any project we say, it depends on multiple factors, like the initial cost of the project, the tenure of the project, then the number of units that you're going to sell, tax rate, price of each unit that you're going to sell, variable cost of each unit, fixed cost. So multiple variables are going to be used to arrive at the NPV or the IRR of a project. So we would really like to know, out of these entire sequence, out of this entire sequence of of the inputs, like the cost, like the initial project cost, selling price, variable cost, which one is really more sensitive? I would like to know that which of these are really sensitive, in a sense that a small change in those factors will lead to the NPV going zero or negative. So why do we do that, sir? Why do we really need to know which of those factors are really critical? Because we want to have a control over it. Because if some factor is really sensitive, we would like to have a proper control over that factor, so that that factor or that number doesn't go haywire, right? So that's your sensitivity analysis. Then the next topic, next technique that we are going to learn is called as scenario analysis. So we create, multiple scenarios by changing the variables. Like one of the scenarios could be, very optimistic. Other scenario would be very pessimistic. Some other scenario may be, moderate. So you understand that, you understand the whole range of, possible NPVs. So we say if we are really optimistic about a project, what's the possible NPV or IRR? If we are really pessimistic, all situations doesn't work in our favor, then we see what's the, NPV. Moderate scenario, if it is, then what's going to be the NPV? So that gives you a broad discussion of, what is the risk that you're facing, what's the maximum loss that you can make, what's the maximum profit that you can make. So that aspect is taken care in the scenario analysis. Then we have decision tree. Again, a really interesting thing where you want to discuss, about the possible opportunities that a project can provide. Generally, if you think in practical sense, I start with a project, and I want to take certain decisions about the project. Today, I start a project. I have another option not to start a project. Okay, today, if I start a project, after a year, I may take a decision whether to expand that project for one more manufacturing facility or stay wherever I am. Now, my decision will depend on what is the outcome in the first year. Now, what is going to be the outcome in the first year? That is something which I don't know. But yes, the possible decisions is something, which I'll be really thinking right now, and then trying to figure out what is the best course of action at that point of time. So when I'm going to involve the future decisions or future alternatives to get the current NPV, that's where we're using the decision tree. So we are really going to prepare a chart where you will find that certain numbers or some sort of, you have decision tree, whether I should take decision one, decision two. If I take decision two, after a year, what's going to happen? There is possible maybe three node. Then again, if I do this, what will be the outcome? So in this way, we are going to form multiple charts. Okay. So that's the decision tree where we are going to visualize the possible outcomes and also understand how do we go about analyzing the risk that is involved in a project. After that, we have something called as simulation analysis. It's called as Monte Carlo simulation. Again, this is a new technique which you will be learning. And this is a new statistical technique also. So at this juncture, you'll be learning something new about statistical technique of Monte Carlo simulation also. So this is again, really interesting topic where the future is, something which we are trying to get visualized and look at the possible outcomes of our simulation. So generally, if you say simulation, I am pretty sure you might have, seen some of the games, some of the video games that we have on our phones, like the car driving simulator, train driving simulator, right? So these simulation are what? They create a realistic scenario on your phones, right? So same way we'll be creating multiple scenarios in our capital budgeting, considering the probability distribution. Okay, so again, there's a new technique that we are going to look at. Now, these are the topics that we are essentially going to target when it comes to risk of a capital project. Okay, so standard deviation, variance, coefficient of variation, risk-adjusted discount rate, then sensitivity analysis, then we have the decision tree, certainty, equivalent. Simulation is something that we are going to learn new, right? And apart from that, there is a really interesting concept called as adjusted present value. Okay, it's a really interesting concept called as adjusted present value. I hope you guys remember Modigliani-Miller model, guys. You remember Modigliani-Miller model from your CA Inter MM model? You remember this? Remember the topic Modigliani-Miller? Yes. We had MM model in two topics. Can you name those two topics? We had MM model in two topics of our CA Inter. Can you name those two topics? One was in capital structure and the other was in dividend decision. Correct, guys? So we had in capital structure, we had MM model with taxes, without taxes, right? So we are specifically looking not at the dividend decision aspect, but we are looking at the capital structure MM model. So in capital structure MM model, I don't know if you can recall something we had, value of a levered firm is supposed to be equal to value of unlevered firm plus debt into tax rate. Do you remember something from some formula like this? That a levered firm value will be, unlevered firm and add to it tax saving on the debt, right? So this was our adjusted present, MM model which we had. That concept is now being brought into the capital budgeting decision, where we are going to value a project, uh, assuming first it is unlevered, and then we value it, bringing in the benefit of the tax saving due to the debt. That's our adjusted present values. Okay, so these are the topics that we are going to cover as far as the practical sense is concerned. Apart from that, we do have a lot of conceptual or theoretical concepts to cover, like what is going to be the impact of government policies on our capital project, right? What are the factors, external factors that we are going to face? So there are a lot of such aspects that we will be covering in the subsequent lectures also, such as what if there is a change in the technology, and what will be the impact of the technology change in the capital budgeting decision. Second, what will be the impact of change in the government policies in our capital budgeting decision? Like for example, if you are looking to set up a manufacturing plant for cars, and government comes up with new emission norms. Earlier we were having BS6. Now government is, let's say, looking for BS7 or 8. Then how is it going to really impact my capital project? That is something that we are going to look at. Moreover, the overall macroeconomic scenario impact, the fiscal policy impact, the monetary policy impact, government relations with the foreign countries, the diplomacy. So all those uncontrollable factors also needs to be accounted when we are looking for capital budgeting. We may not be able to exactly measure those aspects in our decision making, but the idea is definitely we should not be ignoring those aspects, right? Because if you are staying in ignorance, then definitely it's going to be problematic area for us, right? So there will be certain project specific risk also, and also external factors like industry specific competition. So these are some theoretical aspects that we are going to also cover in the chapter of this advanced capital budgeting. Okay. Yeah, guys, are we good enough now? Have we got a good roadmap of what we are going to cover in this topic? Yes, good morning, everyone. Come on, be energetic. This is a Monday morning. Why are you acting like you are, the Monday blues? You're still not into the corporate world. Right? So let's be energetic. Let's get started with the first topic of our discussion today. Because whatever we really doing right now, sir, we were just looking at the roadmap of what we are going to cover, right? So let's get started with the first topic, which is impact of inflation on capital budgeting. Impact of inflation in capital budgeting. Okay. Abrakesh is asking why D is multiplied with T in the formula. I promise you, Abrakesh, you be with me till the last session. I'll give you a really interesting insight into why D is getting multiplied by T with mathematical explanation, with logical explanation. Stay tuned with me till your last lecture. Promise you, I'll not let you go without having a conceptual understanding of it. Okay, sure. Let's get started with the first aspect, which is impact of inflation on the capital budget. We all know, guys, we as an economy, Indian economy, or you take case of any other economy, be it US, be it England, be it France, be it China, all the economies are subjected to some or the other degree of inflation. We are going to be affected to some extent by the inflation, right? So inflation means what, sir? What do we really mean by inflation? So inflation means rise in the price level of the commodities. Some high funda language says, uh, you know, that inflation is going to reduce the purchasing power of our money. So today, if I have a lakh rupees in my savings account, and if I can buy certain commodities with that 1 lakh rupees, of course, the same number of units cannot be purchased by us in the future years, right? For example, if this particular pen is costing us maybe uh, 10 rupees today, so maybe after 5 years it's going to cost us 15 rupees or maybe 20 rupees. So that's the inflation, that's the rise in the price of the commodities, but fall in the value of money. When the prices of commodities rise, value of money reduces. I hope we know that simple concept, right? So as the price of commodities rises, the same price will fetch you lesser commodities, right? So when we are looking at capital budgeting decision or investment decisions, we are looking at longer time horizon, generally greater than a year, right? So of course, year on year, the prices rise and there is an impact of inflation on the prices. So what, when we are forecasting the cash flows of future, we need to take an account of those aspects also. We need to consider that aspect of inflation on the capital budget also. Okay? So we are going to learn something called as uh, real cash flows and nominal cash flows. Okay, real cash flows and the nominal cash flows. Now, for example, let me just look into the revenue aspect, just the revenue aspect. So let's say year and the units that we are looking to sell. So first year, second year, third year, fourth year, right? So 4-year project. Let's say we are looking at every year, we will be able to sell 1,000 units. Okay, we'll be able to sell 1,000 rupees, 1,000 units. Sorry. And we say selling price is going to be, suppose, 10 rupees per unit. Selling price is, let's say, 10 rupees per unit. Now, of course, this price needs to be defined at what level are we really talking about this price? Are we talking about this price at current level, or are we talking about this price for any of the future years? So, of course, when we are looking at the selling price, this is the price at our current level, right? So, if I'm looking at what is the likely cash inflow in future, we can say sales at current price levels. Sales at current price levels. Can you tell me what will be this amount of sale at current price level? What will be the amount of sale at current price level? Can you say 10,000? Because that's 1,000 unit multiplied by 10 rupees. Right? So that's 10,000 rupees at current price level, and that is as of now remaining constant. Correct? As of now, we say that's going to be constant. This is the sales at current price levels. Now, of course, if my units are like 1,000 in the first year, 1,200 in the second year, and let's say 1,500 in the third year, and 2,000 units in the last year, of course, my level of sales are going to change. Right? So initial year, it is going to be, of course, 10,000. Right? Then subsequent years, we find that it is 12,000, 15,000, and 20,000. Now, this rise in the sale value, is it due to the rise in the selling price? No, it's not due to the rise in the selling price. This is due to the rise in the units. Correct? Now, if this same question I say, right, you need not, if you want, Sahil, you can just take running notes for this. But anyways, I'm going to upload this class notes after our session gets over on our viewers portal. You can access this from the viewers portal also. The assignment has already been uploaded, so we can take questions from there. But yes, this is going to be uploaded. So if you want, you can write it down. But yes, solving wise, you can do it along with me also. Okay. So at 10 rupee selling price, we find that the sales at current price levels is so and so 10,000, 12,000, 15,000, 20,000. Now, we haven't yet considered the inflation. If I give you an information that inflation rate per annum, let's say every year there is going to be inflation in the economy to the tune of suppose 5%. So every year your prices are going to rise at a rate of 5%. So can you tell me what will be the price per unit in the future years? Like in the first year, what will be the price per unit? In the first year, what will be the price of per unit? Because this 10 rupees was the selling price at current level. Okay. Can I say it will be 10 multiplied by 1.05? Correct. So price per unit is 10 multiplied by 1.05. That's the price which we have for the first year. What about the second year? So second year is going to be 10.05 multiplied by 1.05 again, because you add 5% to the previous year prices. That becomes 11.025. Then on this same, we multiplied with again 1.05, which is 11.57625. And then again this multiplied by 1.05 will make it 12.1556. So let's just take it up to 2 decimal maybe. These are the prices that we expect to persist in the future years. And now, when I calculate sales at future price levels, sales at future price levels. Now, can I say I need to multiply this price with the units? That's 10,500, 13,230, 17,364, and 24,310. So these are the sales that is happening at the future price level. Now, what's the difference? The initial cash flows that we had over here, these are the sales at the current price level, that is today's price level. But the other side that we have, these are the sales that is happening at future price levels. Out of these two, let me ask you a question. Which one do you feel is the real cash flow and which one do you feel is the nominal cash flow? When we are standing today in year 0, which of these two cash flows do you see that one is a real cash flow, another is a nominal cash flow? Yeah, tell me which one is a real cash flow, which is a nominal cash flow. The first case, is it nominal or real? Or the second case, is it nominal or real? Yeah, all of you are, some of you are still, not getting into that idea. See, real cash flow means in current value terms, right? This set of cash flows that we have, this set of cash flows that we have is called as nominal cash flows. They're the nominal cash flows. Whereas on the other side, this cash flows that we have are called as real cash flow. Okay, real means at the current price levels. I hope you might have learned something called as real GDP and nominal GDP. Real GDP and nominal GDP, right? So if there is a rise in inflation in the economy, your nominal GDP will increase, right? Because people are spending more to get your goods and services, but your real GDP won't increase. Real GDP will increase only if quantum of goods and services are increased. So when there is no consideration of inflation, that's where you say that it's a real cash flow. In foundation also, you might have learned a chapter called as index numbers. Right? Have you all learned this chapter, index number? Right? So you might have learned some of the index number techniques, and there you used to do something called as deflating the prices. We used to bring the future price level to the current levels, right? So future price levels are your real cash flows. Current price levels are your, sorry, my bad. Future cash flows are your nominal cash flows, future price levels, and when you're calculating cash flows at current price level, that's your real cash flows. These are the set of real cash flows. Now, my question to you, can I use the same discounting rate to discount the real cash flows and also the nominal cash flows? Can I use the same discounting rate to count for or to take the present value of real cash flows as well as the nominal cash flows? Can I use the same rate? Or it has to be a different? It has to be different, right? Because when your prices are inflated, how can you use the same discounting rates? Right? So the idea is the real cash flows will be discounted at, these are going to be discounted at real rate of return, right? And nominal cash flows are going to be discounted at nominal rate of return. Are we getting this, everyone? Does it make sense to you? Real cash flows should be discounted at real rate of return and nominal cash flows should be discounted at nominal rate of return. Now, my next question to you. Number-wise, numerically, what do you think? Which number is going to be higher? The nominal rate of this return or the real rate of return? Which number is going to be higher? The rate of discounting, which number is it going to be higher? The real rate of return or the nominal rate of return? Exactly. Correct, guys. Absolutely correct. You're talking of nominal rate as an including inflation. So nominal rate should be having a higher number, right? Because nominal cash flows includes an impact of inflation. Nominal cash flows include an impact of inflation. And due to that, apart from getting a normal return that you're looking from a project, it should be also compensated for the inflation. Therefore, nominal cash flows will be at a bit higher levels. Okay, so let's first understand what's the relation. We hope we have understood what's the relation between a real cash flow and a nominal cash flow. Now it's time for us to understand what's the relationship between a nominal return and a real return. Obviously, we say that the real rate of return will be definitely lower than nominal rate of return, right? This is something that we can definitely vouch for. Okay, that the real rate of return should be lesser than the nominal rate of return. So now we need to know, sir, how much it is less or how we get the nominal rate of return. So for that purpose, what we need to really do is understand the relationship between nominal rate and real rate. Okay. Let's see. Relation between real rate and the nominal rate. Okay. I'll be sharing this, guys. This Excel file will be there on the portal after today's class. That's an assurance from my end. So if you wish to write, you can definitely write it, but I'll be providing you this within our portal getting uploaded. Okay, relationship between real rate and the nominal rate. How do we get the nominal rate from a real rate? It is quite obvious, sir. A layman would also understand. Sir, nominal rate will be higher due to the impact of the inflation because I need to count inflation also into our calculations. So how do we really get this nominal rate, right? So the idea to get nominal rate is, let's say from a project, you need a real rate of return, let's say 6%, right? So your required rate of return from the project is, let's say, 6%, or a real rate of return which you expect from a project is 6%. And the ongoing inflation in the economy is, suppose, 5%. Inflation in the economy is 5%. Can you tell me what should be the rate of return that you should be expecting from the project? What should be the rate of return that you should be expecting from the project? If I talk of nominal rate, yeah. What should be the nominal rate of return which you should be expecting from the project? Nominal rate of return. Real rate of return is 6%, and the prices are going to rise in the market at 5%. Well, some of you may say, let's add them, sir, because we need 6% return and also 5% return because the money that we have invested, that should be also getting inflated by 5%. Total, you may be thinking that it should be 11%, right? Some of you may be thinking, sir, 6% is the real rate of return. On that, we will add 5% of 6%. So that will give me 6.3% return. The second one is, absolutely not at all acceptable. 6.3 is something, that's not correct. 11%, yes, for a layman, we can say, okay, 11% is your nominal rate of return because you don't understand the effect of compounding. But the persons who are really professionally understanding the finance domain, they know the power of compounding, right? You can just check for the power of compounding that's prevailing in the economy, guys. People enjoy this power of compounding when they create wealth, right? So that compounding aspect needs to be given effect over here, right? So, like, I'll just explain it with very basic sense. Rupees 1 invested today should become, Rupees 1 invested today should become some number after 1 year. It should become some number after 1 year. So Rupees 1 invested today should become some number after 1 year without any inflation in economy. Can you tell me how much should 1 rupee invested today become after 1 year, assuming that there is no inflation in the economy? Can you tell me what should be the value of 1 rupee after 1 year? Tell me what should be the value of 1 rupee after 1 year if there is no inflation? Can I say 1 rupee should become 1.06? Right? Because it should grow at 6%, right? You want a real rate of return at 6%. So can I say 1 rupee invested today should become 1.06? This should become rupees 1.06 after 1 year without any inflation in economy, right? Now, since there is an inflation, can I say this 1.06 should also grow by 5% additionally? Because there is inflation in the economy, right? So my investment, if it becomes 1.06 and there is inflation of 5%, do you say you have earned a real rate of return? You say that you have earned a real rate of return of 6%? If your money, 1 rupee is becoming 1.06, but in the market, there is an inflation. In the market, there is an inflation of 5%. Sir. So this 1.06 is not going to fetch you 6% extra. 1.06 is not going to fetch you 6% extra because there is already a rise in the inflation. Price levels have already increased, right? So when you understand the real rate of return, we want the increase in the commodities that we can buy, right? If I say I can buy certain units at 1 rupee today and my real rate of return is 6%, then I say I should be able to buy 6% extra units. I should be able to buy 6% extra units after a year. Am I right? Am I right, guys? I should be able to buy 6% extra units. If my real rate of return is 6%, I should be able to get 6% extra units after a year. Right? So let's say 1 rupee was giving me, 100 units of a commodity. Yeah, for example, rupee 1 was equal to 100 units. Right? So tell me what is the number of units that you want after a year. Units required after 1 year, assuming no inflation. Of course, we need 106 units, right? So now this 106 units is essentially equal to, can I say 1.06? Assuming that there is no inflation. If I say that there is no inflation, if you want 106 units after 1 year, you should be getting 1.06. Now, since there is a inflation in the market by 5%, since there is a inflation in the market by 5%, do you feel that same 1 rupee, after a year is going to give you 106 units? Not possible, sir. Right? So now, due to inflation, units that can be purchased after 1 year with 1.06. Let's try to understand how much units can we really get due to this 1.06. Due to inflation, units that can be purchased will be how much? Because now 1 rupee equal to 100 units in year 0. How much is this 1 rupee going to be? How many units in year 1, guys? What will be the number of units that you can get for 1 rupee if there is an inflation? Suppose if there is an inflation, what will be the price per unit in year 1? Because earlier, in year 0, we had price per unit. We had price per unit as 1 paise. Correct? Price per unit was 1 paise. Now, since there is an inflation, the price per unit will be 1.05 paise. Am I right, guys? So, price per unit is going to be 1.05 paise, because if one unit was giving you 100 units in year 0, price per unit will be 1 paise in year 0. But when we go to 1 year later, price per unit in year 1 is going to be 1.05 paise, because there is an inflation of 5%. So price levels have increased. So now due to inflation, this 1.06 rupee can fetch you how many units, guys? Tell me, 1.06 rupees is going to fetch you how many units? Can I say it's going to be 1.06? 1.06 divided by 0.0105, which is nothing but 1.06 divided by 0.0105. That's 100.95 units only. Right? So is your 106 rupees now going to give you 6 units extra? Because earlier 100 rupees was giving you 100, 1 rupee was giving you 100 units. So that 1.06, is it giving you additional 6 units? No, because the price levels have increased. The price levels have increased, and therefore 1.06 is now not worth 106 units. That is worth 100.9524 units. So rupees 1 invested today should become 1.06 without any impact of inflation. Agreed. But if I want to bring in the impact of inflation, what should I do? See, after considering inflation, 1.06 should be 1.06. Further, it should get multiplied by 1.05. It should get multiplied by 1.05 to give you the impact of inflation. So 1.06 should be further getting increased by 5%. So 1.05. So can we say this is 1.06 multiplied by 1.05? That gives us 1.113. 1.113. So if your rupees 1 becoming rupees 1.1130, is 1 becoming 1.1130, will ensure inflation is accounted. Now, if I ask you how much can you really get, what is the number of units that can be purchased, number of units that can be purchased with rupees 1.1130. Now just check what is the number of units that you can get with 1.1130. Can I say it will be 1.1130 divided by 0.0105? Just see what's the number of units divided by 0.0105. See, now can we say 106 units is a possible reality if the project is going to give me a nominal rate of, if 1 rupee becoming 1.1130, can you tell me this translates to what nominal rate? Because when your 1 rupee becomes 1.1130, can I say nominal rate over here is 11.30%? Because 1 rupee becoming 1130, so there is an increase in the investment rate by 11.30%. So if your 1 rupee becomes 1.1130 after 1 year, that will make you to afford 106 units. But if it is just becoming 1.06, that's not going to be affording you 106 units. So idea over here, put it in a nutshell, is Sir, 1.06 multiplied by 1.05 should be equal to 1 plus the nominal rate. Or to put it other way around, we can simply have an equation as 1 plus the real rate multiplied by 1 plus the inflation should give us 1 plus the nominal rate. We can simply use this equation, guys. We can simply use this equation to arrive at you can use this particular equation to arrive at the real rate from the nominal rate and also nominal rate from the real rate. Am I making sense to you now, guys? Are we able to understand this concept? It's very interesting concept of real and the nominal rate. And just touching upon the basics in detail, guys, so that you go home without any single question in your mind as to why did we multiply that, why did we add that, why did we divide that. So there shouldn't be any such query in your mind. Therefore, I'm going into very detailing about the basic concepts. Does this equation make sense to you now, everyone? Does this equation make sense to you now? 1 plus the real rate, you multiply it with the inflation rate, and then you get the nominal rate. Yes? Okay. I know it's a bit of calculation, so but the idea is simple, fundamental. You cannot just add real rate and inflation to get the nominal rate. You need to follow the rule of compounding. 1 rupee becoming 1.06 after a year, that needs to again be adjusted for the that year's price levels to arrive at the nominal. Okay, guys. Now it's time for us to look at the assignment number 1 or the question number 1 that we have in the assignment to understand the calculation of real rate of return and the nominal rate of return or the NPV using real rate and the nominal rate. So let me just come up with this assignment. So here we have this question number 1. Let me just take this, paste it in my Excel file so that you will be able to solve that. So here's the question. Yeah. So question says there is an initial outlay of project of 40,000. Okay. And additional revenues, sorry, not additional, annual revenues without any impact of inflation. That is 30,000. Annual cost, excluding depreciation without any inflation, is 10,000. Useful life is 4 years. Salvage value is nil. Tax rate is 50%, and cost of capital, including inflation premium of 10%, is 12%. So can you tell me what is this 12% rate? Is it a real rate or is it a nominal rate? Is this a real rate or is this a nominal rate? Yep, tell me. Is this a real rate or a nominal rate? Because 12% they say it is including the inflation premium of 12%. Including the inflation premium of 12% of 10%. So that's obviously 12% is the nominal rate of return. So you can say nominal rate of return is 12%, right? Then initial outlay of the project is 40,000. So let's try to solve this by two methods. One is getting the nominal cash flows, discounting it at nominal rate. Second is getting the real cash flows, right? Getting the real cash flows and discounting them at real rate. Okay. So since we have this nominal rate, let's try to get the nominal cash flows first. So let's try to get the nominal cash flows. The nominal rate is 12%. So we need to get the nominal cash flows also. Now, what will be the nominal cash flows over here? First of all, annual cash flows at current price levels. What will be the annual cash flows at current price level? Can you tell me what will be the cash flow in this per annum basis? What will be the cash flow in this project per annum? So every year, what will be the cash flows at current price levels? What will be the amount of cash flows at current price levels, guys? Can we calculate it? Yeah, it's pretty simple. We have 30,000 as a revenue, right? From that, you subtract 10,000 as the cost, right? Let me just have it in the form of a tabular. Let me get that numbers. Annual cash flow at current price level. For that, we'll say revenue will be 30,000. From that, we need to reduce the cost. So cost will be, 10,000 is specified. That will give us a profit before tax, right? So profit before tax is 20,000. From that, we subtract the tax amount, right? So tax amount is going to be equal to this multiplied by tax rate of 50%. That's 10,000. Then we have a profit after tax of, can we do this profit after tax? Correct? Wait, sir. There's a mistake, right? Absolutely. We cannot take this as PBT because I further need to subtract one more item over here. Since we have a taxation in this question, I need to give impact of depreciation. Perfect. We need to give the impact of depreciation. Suppose depreciation, what will be the amount of depreciation, guys? There's an initial outlay of 40,000 and annual cost excluding depreciation, or if you look at the salvage is nil. So amount of depreciation, what is the amount of depreciation per annum? Amount of depreciation per annum, it will be 40,000 minus 0 divided by the project life, which is 4 years. That will be 10,000. This will actually give us the profit before tax. Profit before tax is, let me write them as a negative number. Okay, so profit before tax will be 30,000 minus 10,000 minus 10,000, which is coming out to be 10,000. Of course, from this, we are going to pay the taxes. Is, I think, 50%. Yeah, 5,000. And then we get a profit after tax. Profit after tax, which is 5,000. Then can I say we add back the depreciation? I hope you remember this from your CA Inter. We add back the depreciation, which is to the tune of 10,000. So my cash flow after tax per annum is going to be PAT plus the depreciation. Cash flow after tax per annum is going to be 50,000. Am I right, guys? These are the annual cash flows at current price level, which is going to provide us 15,000 as the cash flow after tax. You can actually calculate it another way also by simply taking 30,000 minus 10,000. On that you multiply with the tax rate of 50%, and you add the tax savings on the depreciation. That would also give you the same number of 15,000. Either way, you can do it either way around. So you can have a schedule like this where you calculate the PAT and then add back the depreciation, or you can also do it in this pattern also. Okay. So cash flow after tax will be 15,000. I hope this makes sense to everyone that cash flow after tax per annum is going to be 15,000, and this is at current price levels. So this 15,000, can you tell me, is it a real cash flow? Is it a nominal cash flow? The 15,000 that we have computed, is it a real cash flow? Is it a nominal cash flow? It's a real cash flow because we have not considered the inflation impact in this. Now, if I want to get, let's say, the nominal rate, if I want to get the nominal rate, how do we get the nominal rate? How do we get the nominal rate? Can you tell me? Can I say I need to add the inflation to this, right? So since we have the nominal rate of return 12%, I am going to get the nominal cash flows. Yeah. So if this is a real cash flow, can you tell me what will be nominal cash flow in year one? Nominal cash flow in year one, can I say it will be 15,000? Adjust for the inflation. What is the inflation in the market? What's the inflation given in the question? Yeah. What is the inflation? 10%, right? So can I say 15,000 at current price level would translate to how much after a year? That will be 15,000 into 1.1, which is 16,500. Correct? Then what will be the nominal cash flow in the second year? Nominal cash flow in year two. Can I say it's going to be 16,500 multiplied by 1.1? This is 16,500 into 1.1. Correct? Then the nominal cash flow in year three, that's going to be 18,150 multiplied by 1.1, because every year there is a rise of 10%, right? This into 1.1, and the nominal cash flow in year four will be 19,965 multiplied by 1.1. That becomes 21,962, 21,962. Can I say these are the nominal cash flows? I hope we are understanding how did we get these numbers of nominal cash flows. Are you good with this, guys? The nominal cash flow numbers. Every year we are increasing the prices by 10% inflation rate. Correct, guys? We are good with this. These are our nominal cash flows. Now, when I want to calculate the NPV for this, calculation of NPV, using nominal rate. Yes, Mamta Kumari, what's the doubt? Please ask the question quickly. Yes, ask the question. Till that time, I'll just go forward and calculate the NPV. So here 0, 1, 2, 3, 4. Initial year, we are making an investment of 40,000, right? Amita is asking, why did we deducted only 10,000? Where did we deduct only 10,000? In which case you are saying? Because our cash flow after tax is 15 over here. Even if you follow the other method, that's also going to give you same 15,000. But these are two different approaches that we follow, right? Compute the CFAT. We are following two different approaches. Okay, you want me to unmute? Okay, Mamta. Yeah, Mamta, please.
Sir, in second approach, we deducted only 10,000.
Sorry?
That is only cost value, but we have not deducted depreciation. Why,
Where?
sir?
We have deducted depreciation 10,000. Over here?
Yes, but in second approach. But
In
in
the
second
second
approach,
method.
I asked
In the
in
second
second
method.
Yes.
You're
Yes,
saying in the
sir.
second method, this one.
G.
So here you see that in the first method, we subtracted depreciation and then we added back the depreciation. Right. In this
Yes, sir.
second method, what we
Yes.
do is we consider only the cash flow, after tax cash flow numbers, plus we add back the depreciation savings on depreciation
Okay.
saving due to the tax.
Okay, sir.
Okay,
But we
so
have
you
deducted
add
only
10.
cost. Sir, I am asking. We have not deducted depreciation, but added back.
Yeah, added back only half of it. 10,000 into 0.5.
Yes, sir.
We have added half only because ideally 10,000 is not your cash flow. It's not a cash outflow depreciation, right? So you add back only the half of it. Even over here also, we subtracted 10,000. We had the tax saving on it, and then we added back the depreciation. So basically, I'm getting a cash inflow due to the tax saving only. There is no cash outflow of depreciation as such.
Okay, sir.
Okay?
Understood, sir.
Yeah.
Thank you, sir.
Okay. So cash flows, we say zeroth year it is minus 40,000. First year, we computed the cash flow as 16,500. Second year, 18,150. Then third year, 19,965. And then fourth year, 21,962. Now, present value factor, I need to get at what rate is? Tell me the rate at which I should get the present value factor here. What should be the rate at which I should be getting the present value factor? Should it be 12%, right? Because it's a nominal rate. So present value factor will be at 12%. So we know present value factor, you can simply calculate in the calculator also, or I can say 1 divided by 1.12 to the power of number of years. You can calculate these numbers in your calculators also, you get the same numbers. Let me just take it up to maybe 4 decimals. And then we take the present value, cash flow multiplied by 1, and then take a total summation of all of the cash flows. That will essentially give us the net present value of cash flows. Net present value is what we have the number over here as 17,368.83. Okay, so this is the method. This is the first method where we discounted or where we are trying to calculate the NPV using nominal rates. Right? So this was calculation of NPV using nominal rate of return. Calculation of NPV using nominal rate of return. Calculation of NPV using the nominal rate of return. Okay. Now we have to look for the next method, which is calculating the NPV using real rate of return. Okay. So let me do that. Let's just get into that part. Same question, guys. We are going to do it. We are going to calculate the NPV using real rate of. So we'll say calculation of NPV using real rate of return. Now, do we remember the real rate and the nominal rate formula? Can I say it was 1 plus real rate multiplied by 1 plus the inflation, right, was equal to 1 plus nominal rate, right? So from this, can you calculate the real rate of return? Just give you a minute's time to calculate the real rate of return. Please try to calculate the real rate of return here. Try to calculate the real rate of return, guys. You know the cost of capital, which is the nominal rate is 12%, and 10% is the inflation rate. So just substitute over here. So this will be your equation like 1 plus the real rate multiplied by 1 plus the inflation rate. Inflation rate is 10%, should be equal to 1 plus 12%. To get the real rate of return, guys, get the real rate of return. Yeah, one of you have answered. I expect few more people to answer this. Come on, it's a mathematical number. Give me a real rate of return. Yeah, okay. So ideally, when we want to calculate this, we'll say 1 plus real rate equal to 1.12 divided by 1.10, right? And that will give us 1 plus real rate equal to 0.12 divided by 1.1, gives us this number, right? So real rate will be this number minus 1. So the real rate of return is this minus 1. So if this is the number, then we'll say real rate is nothing but in percentage terms. When we express this in percentage terms, this is 1.82%. If I consider maybe 2 more decimals, that's 1.8182%. Are we getting this number? Yes, real rate of return. In exams, optimal number is 4, 3 or 4, that is okay. So rounding up. Fine. So we have got the real rate. Now we are going to discount the real cash flows using real rate of return. So do we have the real cash flows calculation? Yes, we have this real cash flows. We just take it down again over here. So we know the nominal rate is 12%, but that's not relevant for us because we are not going to take the real rate of return. So real rate of return is what we have computed, 1.8182%, right? Now, these are our real cash flows. So annual cash flows at current price levels. This means nothing but these are your real cash flows, right? The annual cash flows at current level is nothing but your real cash flows. Now, we are going to discount this using the real rate of return. See, calculation of NPV using real rate. Same method. You can say the format is going to same. Year cash flows and then PV factors. Cash flow first it is minus 40,000, but now every year this cash flow is going to be 15,000 because these are the cash flows at the current price levels. But now we are not going to take the present value factor at 12%, but we are going to take present value factor at 1.8182%. 1.8182%. Okay. So now these discounting factors, you can just compute in your calculator also. Right? So discounting factor, you can get it in the calculator by simply doing 1 divided by 1.018182. Right? So calculator, I'll just show you how to get that number in calculator also to you. Okay. So we can get this 1 divided by 1.018182. When you do it equal to, you get this 0.9821. Again, when you press equal to, you'll get 0.9646. Again, equal to, that will be 0.9474. And again, equal to, will give you 0.93046. Right? So this is simply the cash flows that we have. Net present value 17,368.81 is the net present value. Okay. So that's our net present value, guys, 17,368. Is it matching with the number that we have got earlier? Yes. You can discount your nominal cash flows using nominal rate or discount your real cash flows using real rate. Answer in both cases is going to remain same. The net present value, because we want to know the worth of the project today. So in present value terms, we still have this same number. Yeah. Are we able to understand this, guys? When we say NPV, when we calculate using real rate and using nominal rate, in both cases, we are going to get the similar answers. Perfect. There is a minor difference, you can say 0.83 and 0.81. That's because of the rounding up and nothing great in it. Am I right, guys? Are the two methods absolutely clear to everyone? Are the two methods absolutely clear with everyone? The most important part was two takeaways from this question. First, how do we get the nominal cash flows? From the cash flows that we have obtained in the current year levels. That is one thing where you need to increase the cash flow every year by 10%. And the second thing is how to calculate the real rate using this simple equation of 1 plus real rate into 1 plus inflation is equal to 1 plus the nominal rate. I hope this makes sense to everyone, and this is good enough to take us to the next question of our discussion right now. The next question is question number 2 from our assignment, which is this question number 2. Again, this is going to be inflation adjustment. Let's try to discuss this in our second question. Okay. Second question, guys. Please go through the question first initially, and then we can take up for this question for the discussion. XYZ Limited requires 8 lakh for an unit. So we're going to invest 8 lakh rupees. Useful life of the project is 4 years. Salvage value is nil. Depreciation charge is 2 lakh per annum. Expected revenues and costs, excluding depreciation and ignoring the inflation. The revenues and costs are given, which are in absolute terms. I mean, which are excluding the impact of depreciation. The depreciation is not included in the cost, and also there is no impact of the inflation. So this revenue and cost, can you tell me, are they real rate or nominal rate? I mean, are these cash flows real cash flows or nominal cash flows? I mean, revenues, are they real revenues or nominal revenues? And same goes with costs. Real or nominal? Real or nominal guys? Yeah, they are real because they are saying that we have not considered inflation in this. There's no impact of inflation in this, right? Then the tax rate is 60%. Capital cost of capital is 10%, which is including the inflation premium also. Calculate the NPV of the project if inflation rates for revenue and costs are as follows. Okay. Now, here we have the cost of capital as 10%, including the inflation premium. Can we compute the real rate of return from this? Because when we are calculating NPV, the revenues are having a different set of inflation. Costs are having a different set of inflation, which is quite obvious, which is quite possible that one of your products, one of your products will be, one of your item may be having a higher rate of inflation, other may be having a lower rate of, right? It may be possible that your revenue is not going to have the inflation impact of that much as your cost, or it may be the other way around also. The revenue is having an inflation at different rate, cost is having a inflation at different rate. Right? But this 10% is including the inflation premium. So can we compute the real rate of return over here? No, because inflation is different for each of the years. Right? So for each first year, second year, third year, fourth year, we find that inflation is different, and therefore we cannot calculate the real rate. So we have to solve this using nominal rate only. Is this first part clear, everyone? Since the cost of capital is 10% and the inflation rate is not constant, I cannot apply the real rate of return over here because every year there is a different rate of inflation. I cannot apply this equation once and simply get the real rate. That's not possible because inflation every year it is different. So I have to essentially use what? I'll have to essentially use what rate of return? Nominal rate. Is this clear, everyone? Why are we going to solve this question using only nominal rate and not the real rate of return? Is this part clear, everyone? Because inflation rate is not constant. Inflation rate is different for different years. So how do I calculate one single real rate of return? Right? So this question cannot be solved using the real rate of discounting. Rather, we have to solve it using nominal rate. So can I say I'll have to translate all my cash flows? I'll have to translate all my cash flows into nominal cash flows, correct? Am I right, guys? Can I say my nominal cash flows? I mean, all the cash flows have to be computed on a nominal cash flows. We cannot use these cash flows for discounting purpose because we are not going to use the real rate of return. We can say since inflation is different for each year, rather you can say even revenue and costs are having different inflation rate, right? So since inflation is different for each year for revenue and cost, we will calculate NPV using nominal rate of return. Okay, I hope this is very well registered in your mind that since we cannot calculate the real rate, we will not be able to use the real rate of discount. So since inflation is different for each year for revenue and cost, we will calculate NPV using nominal rate as real rate cannot be computed. Okay, so nominal rate is given. That is what we are going to use to discount the cash flows. Now, how do we get the nominal rate? By the way, guys, there is a shortcoming or a mistake that we have done in this method. Or not, rather I can say over here, this one, there is a mistake that we have committed over here. Now, what is that mistake that's going to be understood in this question? So they have given us the inflation to get the nominal revenue, to get the nominal cost. These numbers are given for us to get the nominal revenue and the nominal cost. Got it, Abrakesh? They have given the inflation rates, but I have to get this inflation rate. I have to use this inflation rate to get the nominal amount of revenue and the nominal amount of cost. Practically, inflation rate for revenue and cost are same? No, they aren't. Inflation rate for revenue and the costs are not going to be same. So as I was saying, there was a mistake that we committed in the previous question, which was, which was actually not, pointed out by any one of you. And I didn't expect it also because it is very, deep hidden inside the question. It's hidden inside the question. So now what's the problem? What's the mistake that we did? Let's try to understand that. We calculate cash flow after tax as revenue minus cost, right? And then we can I say from that we subtracted the depreciation, and then on that we multiplied the tax rate, or we made it as 1 minus t, and then added the depreciation. Can I say CFAT was calculated in this way? Cash flow after tax was calculated as revenue minus cost minus depreciation into 1 minus t plus the depreciation amount, right? Correct, guys? I hope this equation makes sense to you. Yeah. Okay. Let's try to break it open, and we'll see, new avenues coming for our discussion. We can simply say, so this 1 minus t, let's take it inside, and we'll say it is revenue minus cost into 1 minus t minus depreciation into 1 minus t add depreciation. I just multiplied this 1 minus t with revenue minus cost as one component and with depreciation as another component, and then we added the depreciation part. Okay, so if I just break it open further, I say revenue minus cost into 1 minus t. When we open this entire bracket, this will be like minus t plus d multiplied by t plus d. You can find this minus depreciation and plus depreciation will get cancelled. And what we are essentially left out is revenue minus cost multiplied by 1 minus t and plus depreciation into the tax rate. Right. So over here, you can say this minus d and plus d gets cancelled, and we are left with only this component. Is this derivation absolutely clear, everyone? Is this number clear? Whatever we have written here, revenue minus cost into 1 minus t plus depreciation into tax rate. We just solved this. We just opened up the bracket, and we are taking that revenue minus cost after tax, and depreciation into tax is the tax saving. If I just break it into two parts, one is revenue minus cost into 1 minus t, right? And then plus the amount of depreciation into tax rate. So we just split it into two parts. Out of these two, revenue minus cost into 1 minus t and depreciation into tax, these are the two components of our CFAT. These are the two components of our cash flow after tax, annual cash flow after tax. So out of these two components, can you tell me which of the component is getting impacted by inflation? Which of these two numbers is going to increase with inflation? Is the revenue and cost going to increase with inflation? Yes or no? Is the revenue and cost going to increase with inflation? Yes or no, guys? Yes, revenue and cost will increase with inflation, right? But do you see depreciation will increase with inflation? Do you feel that depreciation will increase with inflation? No, depreciation is on historical basis. So is the depreciation into tax part getting affected by the inflation? Is the depreciation into tax part getting affected by inflation? Is it going to increase with inflation? But can I say, when we calculated here the nominal cash flows, we increased abruptly the entire CFAT with inflation rate of 10%. Can I say that was a mistake on our part? Are you able to get the crux of what I'm asking you? This 15,000 comprised of two components, 30,000 minus 10,000 into 0.5, this component which was getting impacted by inflation. But this component, is it getting affected by inflation? 10,000 into 0.5, is it getting affected by inflation? Is this, I mean, the tax saving of depreciation of tax saving due to depreciation of 5,000, is that going to increase by inflation? No. But can I say we consider the entire 15,000 and compounded it with 1.1? I compounded it with 10% for every year increase. So can I say that was mistake on my part? So when we delve deep into the concept, then we understand that what are the nitty-gritties of each one of them. So like revenue minus cost into 1 minus t, this portion is going to get impact by inflation. But depreciation into tax has no impact of inflation as it is based on historical cost. Are we able to get this, guys? Are we able to get this, everyone? Please confirm. This component, revenue minus cost into 1 minus T, that should increase with the value of inflation. But depreciation into tax, the cash flow that you're going to get due to depreciation into tax, that's not going to be affected by inflation because that's based on historical cost. Am I correct? Yes. So now, how do we go about solving this type of problem, which obviously we did wrong in the previous question, but now we are going to rectify that part in this question, and rectification of the previous question will be a homework for you. Okay, so we are going to learn now how are we going to change or how are we going to adjust these both factors, how we are going to break our cash flows into two parts and then give the impact of inflation to each one of them and then calculate the NPV. Okay, but that will be a suspense for the time being. Let's take a break of 10 minutes. After 10 minutes, we will understand how do we deal with this problem in this particular question number 2. Okay, so let's take a break, guys. Okay, let's get started. Let's get started. Okay, so now we were in this part where we were looking at the difference between revenue and the cost. We multiplied that with 1 minus t. So we said that this component is going to be impacted by inflation. The other component is not going to be impacted by inflation. So we need to adjust that other component as remaining constant, whereas the other part is going to get affected. So now in this question, we say 8 lakh is an initial investment that we need to make. Useful life of the project is 4 years. Salvage value is going to be nil. Depreciation charge is going to be 2 lakh per annum. And expected revenue and cost excluding depreciation is given to us. So let's calculate the nominal revenue and the nominal cost first. Okay. Now, how do we get the nominal revenue or cost? Simply the real revenue and the real cost, you add it with the inflation rate. Okay. Okay. So let's look at this. We'll say calculation of nominal revenue. First aspect is to calculate the nominal revenue. You can get the nominal revenue by simply writing down the revenue and then adjusting it with the inflation. We have the year, then real revenue. Okay. And in fact, real revenue, then inflation rate, and then finally the nominal revenue. Okay. Right. So year 1, 2, 3, 4, 4 years. And for each of these 4 years, write down the real revenue values. So real revenue values are 6 lakh, 7 lakh, 8 lakh, 8 lakh. Lakh, 7 lakh, and another lakhs, right? Inflation rates are given 10, 9, 8, 7%, 10%, 9%, 8%, and 7%. So nominal revenue will be first one. It's going to be 6 lakh multiplied by 1.1, guys. So that's going to be 6 lakh into 1.1 because since this is the cash flow of the first year, it's going to be, 6 lakh real revenue. Add to it 1 year inflation. That will be 6 lakh into 1.1, which is 6 lakh 60,000. Second year, we say 7 lakh into 1.1, of course, and again multiply it by 1.09. Why are we getting this multiplied by 1.09 again, sir? Because 7 lakh is the revenue at current price level. After a year, that 7 lakh will be 7 lakh plus 10%. After one more year, which is occurring in the second year, that will be 7 lakh plus 10%, which is 7 lakh 70. To that, again, we'll have an inflation rate of 9%. So this is essentially going to be 7 lakh into 1 plus the 10% rate multiplied by 1 plus the 9% rate. Okay, so it's 7 lakh into 1.1 into 1.09. Same way for the third, it's going to be 8 lakh multiplied by 1.1, again multiplied by 1.09, again multiplied by 1.08. Okay. So we are just multiplying every year inflation factor to account for the changes. This will be like 8 lakh into 1.1 into 1.09 into 1.08. That's your cash flow for the third year. I mean the nominal revenue for the third year. Then nominal revenue for the fourth year will be 8 lakh into 1.1 into 1.09 into 1.08, right? And we need to also multiply one more factor with it, which is 1.07, because that's a 7% inflation rate. Right? So that will be 8 lakh into 1.1 into 1.09 into 1.08 and into 1.07. These are the nominal revenues, or inflation adjusted revenues is what we are computing. Right? So inflation, Savita Rani, if you say, why are we adding inflation every year? See, this 7 lakh is the revenue that is going to happen in year 2, but at current price level. But that year, second year, you have an inflation rate as 9%. But in the first year, there is an inflation of 10%, right? So by the time you reach second year, the inflation would have been like, 100 rupee would have become, the product which is costing 100 rupees, that would have become 110 in the second year. And then 110 will be increasing by another 9% in the second year. And therefore, we are going to give a cumulative impact. Is this clear? So every year there is an impact of inflation. It's not that inflation is coming only in that year in which cash flow is coming. Right? But we're earning 7 lakh exactly. But this 7 lakh is as per current prices. As per current prices. If it is as per current prices, when you go to the second year, it will be increasing first year by 10% and second year by 9%. So let's say, if I just want to explain it to you, let's say per unit, it is, suppose 100 rupees. Per unit, it is 100 rupees. So how many units are we selling? We are selling, let's say in the second year, 7,000 units. But this 100 rupee is price in year 0. Now, if I want to calculate price in year 1, tell me what will be the price in year 1? If 100 rupees is the price in year 0, if we have the current year value of price in year 0 to be 100, what will be the price of the product in the second year? Sorry, in the first year? 110, right? Because there's an inflation of 10%. But what do you say about price in year 2 now? Price in year 2, can I say it will be 110 into 1.09? Because even in the second year, there is an inflation. So second year, by the time you reach second year, the price would have become like 110 into 1.09. Right? So 119.9, or I can say approx 120 will be the price. So now what will be your revenue in the second year? Can I say 109.9 into 7,000 units? Which will be 8,39,300, and that's the same revenue which you have stated here. Right? Is this clear? Why are we getting it multiplied every year cumulatively? Clear? Perfect. Great. I just want everyone to be there on the same line, that don't go home without, getting any clarity about the concept. Anyways, so we have this nominal revenues available. Now let's go for calculation of nominal costs. Nominal cost, again, we'll just say a similar format where we write down the year, real costs, inflation rate, and then the nominal cost. But this cost is definitely excluding depreciation, because we know already that depreciation is not going to be getting affected by the inflation. So we write down year 1, 2, 3, 4 for each of these years. We have the real costs. Yes, real costs are like 3 lakh, 4 lakh, 4 lakh, 4 lakh. So let's write down 3 lakh, 4 lakh. Oh, sorry, 4 lakh. Inflation rates that we have in year 1, 2, 3, 4. Inflation rates are, as far as cost is concerned, it is 12, 10, 9, 8. Inflation rate is 12%, 10%, 9%, and 8%. The nominal cost after adjusting for inflation will be 3 lakh into 1.12, right? And then the next will be 4 lakh into 1.12, further multiplied by 1.1. Then next will be 4 lakh into 1.12 into 1.1 into 1.09. And then finally we have 4 lakh multiplied by 1.12, again multiplied by 1.1, again multiplied by 1.09, and the final year 1.08. Okay, chalo, fatafat, give me the numbers. Give me the nominal cost, guys, quick. First, it will be 3 lakh into 1.12. Please calculate the numbers quickly, guys. Next is 4 lakh multiplied by 1 plus this, multiplied by 1 plus this 10%. 44 lakh 92,800. Perfect. The third year is going by 10%. 537 152. Perfect. Okay. The next it will be this multiplied by 1 plus 8%. 5 lakh 80,124. Perfect. So here we have the nominal revenue and the nominal costs, and we are considering the revenue and cost of only those items which are getting affected or which are going to be influenced by inflation. Okay, that's great. Now, inflation adjusted cost is done. There's the nominal costs, nominal revenue is done. Now, something that is not going to get affected by inflation, that will be the next part, which is the tax benefit on depreciation. Tax benefit on depreciation. The question has already specified us the amount of depreciation. What's the amount of depreciation is? The depreciation is basically 2 lakh, but on that 60% is going to be saved because 60% is the tax rate. That's like 2 lakh into 60%, which is 1,20,000. The tax benefit of depreciation is 1,20,000. We already have the nominal revenue, we have the nominal cost, and the tax benefit on the depreciation. Right? Yeah. Okay, then let's go for final getting the profit after tax, or I can say cash profit after tax, and also the tax benefit added to the cash flow. We will compute calculation of net profit after tax, excluding impact of depreciation, because depreciation is going to be taken care in a separate way. So we have this as year nominal revenue, right? We already have the nominal revenue. Then we have the nominal costs. Then we'll get the nominal profit before tax. And then you can simply get the tax amount and then net profit after tax, excluding depreciation impact. Okay, let's try to get them. So years we have 1, 2, 3, 4. Nominal revenue. The nominal revenue is 6,60,000. And we have already computed the nominal revenue. So let's take those nominal revenues into account. Nominal cost is again what we have already computed. Nominal cost is this. Okay. Nominal profit before tax will be, of course, revenue minus the cost. Correct. Tax will be the profit before tax multiplied with 60%, right, guys? The tax rate. Now, net profit after tax, excluding the impact of depreciation, would be just subtracting the PBT, subtracting the tax from PBT, right? This is the net profit after tax, excluding depreciation impact. And then last part that we have as far as the computation of cash flows is concerned is to get the final NPV by using the inflation adjustment thing. So last part is calculation of present values of cash flows. Calculation of present value of the cash flows. So here, impact, of course, excluding the depreciation impact, excluding depreciation. Okay, and then we have tax benefit of depreciation. Okay, tax benefit of depreciation. So we have like year 1, 2, 3, 4, or in the respective 4 years. We have the net profit after tax excluding depreciation already computed by us. Is 129,600 over here, and the respective subsequent numbers. What will be the tax benefit of depreciation? What was the tax benefit of depreciation, guys? Do you remember? What was the tax benefit of depreciation? That is, of course, not going to be inflation adjusted because it's a historical number. So we have computed already. This is 1,20,000. Okay. That's the tax benefit of depreciation. So we'll say now total nominal cash flows. This will be just total of the impact and the tax benefit of depreciation. Once we have the total nominal cash flows, we say present value factor at the rate of 10%, because These are nominal cash flows, so we need to discount these at nominal rates. This will be 1. You can just write down the PV factors. 1 divided by 1.1. Right? The same way, I'm just doing it over here. 1 divided by 1.1. The power of number of years. You can calculate these PV factors in your calculators easily. And then finally, present value will be total nominal cash flows into present value factors. Total nominal cash flows into present value factors, which is the sum of this entire aspect. So in present value terms, we are getting it as 9,06,987. Right? So there may be some way here and there depending on the, some rounding up error is expected. So your numbers may be somewhat different from this. Some marginal differences is possible. So finally, when we want to compute the NPV, that NPV will be 906 is the present value of cash inflows. Right? Is the present value of cash inflows. Then we say minus 8 lakh. Right? So that's minus 8 lakh. And then finally, we get the NPV answer as this minus 8 lakh as 1,06,987. So NPV is positive. So what should be our discussion? I mean, what should be the conclusion? Should we accept this project or no? We accept this project or no? Accept it, right? Rakesh is asking, well, how can we add tax benefit of depreciation when we have not deducted depreciation? Why should I deduct depreciation first? It's not my cash outflow. Depreciation is not a cash expenditure which I'm making. So I'm not going to deduct depreciation. Non-cash depreciation, right? Because we have already derived that aspect over here. Yeah, this one. R minus C minus D into 1 minus T plus depreciation, right? Plus depreciation. So now, if you solve this mathematically, you find that this only translates to D into T. Only this component is what we have considered. Okay, so depreciation is not what I'm paying in cash. Yes, Rakesh, please. You can unmute.
Good morning, sir.
Good morning,
Rakesh.
Yeah.
Sir, why I asked that when we have not deducted a depreciation, when we have not reduced the even before tax impact of the depreciation, then why it is to be added? Because generally in the example, amount of the cash flow given after depreciation. So we add back the benefit of depreciation. Exactly. Here we have not added even, in cost depreciation. So what is, is it not going to inflate the amount of cash flow?
No. Rakesh, see, in this case, what you're saying, depreciation should be subtracted, right? Depreciation should be subtracted and then added. This is what we have done here, right? Correct? Stay unmuted, Rakesh, please.
Sir, that is fine. What I want to ask is total depreciation is to be deducted.
Let me complete. Wait. So okay, mathematically, we have subtracted depreciation and then added back depreciation, right? Then this equation itself, we opened it up, right? So subtracting depreciation and then adding back. Subtracting depreciation, giving the tax effect and then adding back depreciation is same as just adding the tax impact of depreciation. So mathematically, it is just the same.
Okay, fine. Okay. Got it. Yes, yes.
So it's the same thing that we are doing, but mathematically we are separating it.
Yes.
Okay.
Thank you, sir.
Perfect. Yeah. Perfect. Okay. So I hope we are clear till now. The inflation adjustment factor. So one task for you guys, an assignment or homework or whatever you say. The previous question, that is question number 1, that we did using the nominal cash flows. What you should be ideally looking at is nominal rate. I want you to revise this entire solution, right? By taking impact of that concept that we did right now. Okay. And then revise the solution, right? And see if both of them are matching or not. That's a homework for you as far as this particular inflation adjustment is complete. Can I expect you to do that? Can I expect you guys to do that? Yes. So the same treatment what we did in this question, you have to do it for the first question also. Okay. Now, so that is the first part which we were looking at, impact of inflation on capital budgeting. So we have covered this part as far as this topic is concerned. Now, still we have half an hour to go. So let me get started with the next aspect, which is the statistical tool in risk analysis of capital projects. Now, before I start with the risk analysis in the capital projects, I will first, take this today's session to make the statistical concepts clear, basics. And once the basics are clear, then we can simply run the rocket for, application of it into the questions, right? Like, first we got the concept of inflation adjustment. We got to know how the prices are adjusted. We got to know this formula. Then, the questions were, quite smooth enough. So same concept, same way we are going to do over here. And first understand the basics of the statistical concepts that we are going to look at. And then later on, we'll apply them probably in the subsequent classes on the questions. Okay, guys. So shall we get started? Yes. Okay. Now, the first aspect is something called as to compute these assignments are available in the web. They are, you can simply download it from the BOS portal from the assignment section. So we are looking at expected value. Then we are looking at variance in expected value. Then we are looking at standard deviation in expected value. And then we are also going to cover the next concept, which is coefficient of variation. Okay, so these are the basic concepts that we are going to cover right now. So first is the expected value. Okay. Let's say in the upcoming year, the next year, subsequent year, we look at certain scenarios. Right? So scenario, let's say scenario named A may come, scenario named B may come, or let's say scenario is optimistic. Right? Then we say less optimistic, or again, let's say this has scenarios strong optimistic scenario. One of the scenarios that we're looking at is strong optimistic. Then we say weak optimistic. Right? Then we say we may face some moderate scenario. Then we may say there could be a weak pessimistic and maybe strong pessimistic. Right? These are the scenarios that we are likely to observe in the future years. Right? So let's say price of share. So next year, this is price of share in 1 year. Okay, so scenarios may say there are 5 scenarios on the basis of which we have the price of the shares. So price of share in 1 year. Let's say we are expecting that if market is optimistic, there is a bull run going on, government policies are in the favor of this sector or in this company. A stable government is there. There is moderate inflation. Employment rates are very good. So everything, if it is turning out to be, all rosier picture, then we are expecting the price of the share to be, let's say, 500. Peak optimistic, we are a little bit optimistic. Somewhere we face problem, or sometimes we are looking at some problematic area. Then we expect the share price to be 400. So if there is a moderate scenario, we expect the share price to be hovering around 350. Weak pessimistic. So we say, let's say the share price is likely to 300. And if it is, very bad scenario in the market, then we expect the share price to be at least 250. Now, if this is what the future is, I'm giving you a whole, buffet of future prices ranging from 500 to 250. What are you going to really expect the price? What is going to be your expectation about the price? What is going to be your expectation about the price? How much price do you expect for this share in 1 year time? What is the price that you are expecting for this share price in 1 year time price? What is the time? What's the timeline that you're expecting? I'm sorry, not what's the price that you're expecting. Are you going to expect the share price to be 500? Do you expect the share price to be 500? Or do you expect the share price to be 250? Can I say we have an expectation of average? Right? Average all of them, sir. Simple, take the average. Right? A very, very common sense and a very basic way of understanding the expectation is to take the average. Right? So, if we want to calculate the expected price of the share expected price of the share. So expected price of the share, we can say we expect it to be, the average. So let me take simple average, the arithmetic average of the numbers. That is 360. And so we expect the share price to be around 360. But then, you know what? What is the underlying assumption that you are taking over here? You are assuming that each of the share price are equally likely to be arising. So you are assuming that each of the share prices are having a equal probability. So having a strong optimistic scenario is equally probable as weak optimistic, is equally probable as moderate, is equally probable as weak, and is equally probable as strong. But tell me, in practical sense, can you expect all the scenarios to be having same probability? Or do you see that all the scenarios are having the same level of confidence? As an investor, do you see that next year the scenarios that are likely to be, do you expect all of them to be in equally likely, that there is same chance as economic upheaval as there is a chance of economic downturn? Do you say that is the case? Never, say. So you always assign, can I say, level of confidence or probability for each of the likely scenarios. Correct? So we are going to assign probabilities. We're going to assign probability. So we will say we are very much strong optimistic. We are biased towards strong optimistic. We find that as per the market expectation, we are expecting the share prices, to be more skewed or inclined towards the optimistic side. So I say we are like 50% chance. We are having a 50% confidence that we will have a strong optimistic scenario next year. Then weak optimistic chance, we expect it to be around, let's say, 20% chance. Moderate, we expect it to be around 10% chance. Weak pessimistic, we are expecting this to be around 15% chance. And very bad scenario has got a probability of 5%. Okay. So can you tell me what will be the total of the probabilities, it's always going to be 1. Okay. Correct, yes. So probability, total probability is going to be 1 of all the possible scenarios. Now, when you have this range of probabilities, can you tell me, can you still take a simple average? Can you still take a simple average to get the expected price of the share? Can you still take the simple average to get the expected share price? No. Can I say the weightage is different now? For the strong optimistic, there is a different weightage. For a weak optimistic scenario, there is a different weightage. So can I say we need to get the expected probability or expected value? So for that expected value, we need to compute simply probability into price. So what's the probable price? What's the expected price? That's going to be simply 500 multiplied by probability. Right? So price into probability is something that we take, and then we take a summation of all of them. That's 422.5. So expected price of the share is 360, but this is under an assumption of what? This is by simple average. This is by way of simple average. But if I want to say what is the expected price of the share by weighted average, the expected price of the share by weighted average, that is 422.5. Now, why is there a difference between both? Obviously, because in the first case, you assume that all cash flows are having equal weightage. But in reality, the probability or the likelihood of the prices is skewed towards the optimistic, and therefore you'll find the weighted average price is also on a higher side. So this is your expected price. So if I ask you expected value, what's the formula for expected value? Expected value or expected value of X, let's say. How do we get the expected value of X? Just as we did over here, expected value of X is what? It is simply summation of probability into X. It is simply summation of probability into X. Okay. Now, this expected price 422.5, this expected price of 422.5, can you say that this is going to be the price with 100% surety? Can you say that this 422.5 is going to be the price with surety, sir? No. Is it subject to some variation? Is it subject to some variation? Yes or no? This 422.5, is it subject to some variation? Yes. So we want to know what is the degree of that variation, what is the degree of that deviation by calculating the standard deviation. We want to know what is the degree of that deviation or variation by calculating the standard deviation. So let us do one thing. Here, to get the degree of variation, let us calculate the difference between the price. Let us calculate the difference between the price and the expected price. Right? So we'll say deviation from mean. Now, deviation from mean means, when we say deviation from mean, we are essentially looking at deviation from mean means. So let us say we are denoting this as X. Okay, this term for the ease of our calculation, taking this as X, this is denoted as probability, which is P. Okay, this is probability P. correct? Then this was nothing but, sir, P into X, right? Probability into X. Okay. So just rearrange them. Makes more intuitive for us to understand. X price, X into probability, and P into X is what we did. Now deviation from the mean. Now deviation from the mean will be, of course, the value of X minus expected value of X. Value of X minus expected value of X. So 500 is our expected price, but that, 500 is one of the expected price that we have. But we want to know how much is the deviation from the mean. So our mean is 422.5. So by how much units is this price deviating from the mean? Is getting deviated from the mean by how much price? By how much units? Can I say this is your expected X value minus the expected value of 422.5. So the deviation is 77.5. Deviation is 77.5. So same way, we can compute all other deviations also. We can say the deviation is 400 minus 422.5, then 350 minus 422.5. Can I see we're getting the deviations? But can I take the total of these deviations? Can I simply take the total of this deviation and say that this is what the total deviation is likely to be? Acha. Can I take a simple average of these deviations? Can I take a simple average of this deviation and say that this is what the deviation is expected to be? No. Why? Because each deviation has got different amount of probability. Each deviation is having a different degree of probability. So what we need to do is we need to give probability into deviation. We need to take the probability into deviation. So let's multiply probability with the deviation, which is X minus expected value of X. X minus X into probability into X minus expected value of X. So this is simply going to be this expected value minus deviation multiplied with probability. We take the total, and then we have this as 0. So if you take a total of all our probability into deviation, what we observe is this comes out to be 0. Probability into deviation comes out to be 0. Does that mean, if the total of our deviations is 0, does that mean there is no deviation? There is no deviation possible from the expected value? Can we conclude that? Can we conclude that since the summation of all deviations is 0, there is no deviation, sir? No. Now, if I ask you, why is this deviation, why is this probability to deviation coming out to be 0? Why is this probability into X minus expected value is coming out to be 0? I know it will be always 0 statistically, but why? Can I say there are certain positive numbers and there are certain negative numbers, and they are offsetting each other, right? So they are getting offset by each other, and therefore it's coming out to be 0. So how do we remove this aspect now? So one way to remove this deviation due to this, I can say this total of deviation coming 0 because of the probability into that number coming out to be some positive and some negative, is to remove that negative aspect. Now, how do we remove that negative aspect? One way is to consider only the absolute values, which is like take 77.5, take 22.5, take 72.5, but that has got no statistical properties. No, statistically that is not correct for us. So what we do is to remove that negative aspect. What we do is instead of multiplying with X minus expected values, we multiply it with X minus expected value of X, right? x minus expected value of x square. We're simply going to square this term. Now this term, when it becomes squared, before I do this, x minus expected value of x, this term, getting it squared. Now, why do we get it squared? To remove the negative aspect. Like when I multiply the deviation with itself, we get these numbers. Can we say the magnified deviation has become fully positive now? Can I say because of the negative aspects, we are getting the total as 0. So we are going to remove the negativity by simply squaring. By simply squaring them, we get rid of that negative sign. Now let us multiply this with the probability numbers. Now we observe all the deviations are having positive values. And then when I take a summation of it, I find that it is, this is fully positive. And the number that we have computed over here is called as variance. This is called as variance. Variance of x. How do we calculate this variance of x? Is again simply summation of probability into x minus x bar, or expected value, you can say x minus x bar or expected value square. But do you really feel that 7368 is really a measure of deviation in the share price or deviation in the expected share price? Do you see 422.5 to be increasing by 7368 or falling by 7368? No, because it's a magnified number. It's a squared number, right? So I need to rectify it. The squaring that we have done, that has to be again brought back to the original level. So how do we get it back to the original level? How do we get it back to the original number level? Yeah. Square root, perfect. And that square root term is what we call as standard deviation. Standard deviation of x is, formula wise, it is square root of summation of p into x minus x bar square. Or we can also say this is nothing but square root of variance, right? So here we have said that expected value was 422.5, variance is 7368, and standard deviation is square root of this particular number, which is 85.84. Now this 85.84 is a measure of standard deviation, which tells us that our share price can, go up by 85.84 in a realistic scenario, and it can even be lesser by 85.84. Now again, how much up, how much down, that's again a statistical detailing which I am personally not going in this chapter, because we are here to learn something about finance and not detailing into the statistics. But yes, the simple understanding would be there is likely to be a deviation in the share price of 85.84. That's a standard deviation number. Okay, so 85.84 is the standard deviation number, right? How 7368.75? This is just the total of these numbers. So what we have done is, first we took the square of this. Okay, this is the square of x minus expected value. It's not square of p into x minus expected value, because I want to remove the negativity. There is a negativity over here, right? So let's try to remove that negativity by simply multiplying it with it. And then that after that negativity has been removed, then you multiply it with probability. Yeah, Sumit. Yeah, okay, perfect. So we have the standard deviation of 85.84. So we have written down the formula for expected value, for variance of x, and also for the standard deviation. Now, one more thing. Coefficient of variation. Coefficient of variation. How do we calculate the coefficient of variation? Before we calculate, we need to understand why should we calculate coefficient of variation. My question to you: can I compare standard deviation of this share with standard deviation of some other share? Can I compare the standard deviation of two shares? No. Why? Because our prices are like 500, 400, 350. These are in like, our prices over here, these are in 3 digits. It's quite possible that other company might be having share price in 4 digits. It may be having share price in 2 digits, or it may be having the share price in 5 digits also. So can I compare the standard deviation of share price which is in hundreds with standard deviation of a share price which is in thousands? Can we have that comparison? No, right? So it's not really correct to compare the standard deviation. So how do we do the comparison? For comparison, we need to bring it in percentage terms. Whenever it's a relative, we compare it within percentage terms. So that percentage is nothing but coefficient of variation. Coefficient of variation is simply standard deviation divided by expected value of x. Standard deviation divided by expected value of x, which in our case, we say standard deviation is 85.84 and divide it by 422.5. Okay, so in our case, we can say standard deviation upon this is 20.31 or percentage terms. So this indicates that the expected value is likely to get affected by what percentage? 20.32%. Expected value is likely to be getting affected by 20.32%. Okay. Is this clear? Everyone? Yeah, so coefficient of variation, we say it's standard deviation upon expected value. So we are basically trying to get what percentage the expected value is likely to be affected, and that comes out to be 20.32% in our case. Yeah, so that is what I wanted to discuss for our today's session, guys. First, the inflation adjustment fact, and then the basics of the statistical tools. These tools are something that we are going to apply in the subsequent sessions. If you have any queries, you're free to ask right now.
Jagbandhuji?
Yes, sir.
Your session was very encouraging, and initially when you have started, you have made a very good story, and you have also linked the class with the intermediate level as well, because you have discussed how approach that has been covered at intermediate level regarding the valuation of the firm. Okay,
Right.
then you have linked it with the our adjusted present value. It was a wonderful. Thanks a
Thank
lot.
you.
Ashokji, please open the session for the students. Okay, student, if you have any query, you can even just now ask verbally. Jagbandhuji, there was some student query. I think it was in portal. Have you seen it?
No, it was regarding whether this assignment will be available or not.
No, no.
So I've told them we'll upload this.
There was one query of Khushi Bhatia. I think she have some issue in nominal cash flow. Like, just you check the same query handler. Okay, okay, student. Now I am just briefing what the sir has discussed. Now, when we talk about the inflation, please remember the golden rule. We can say that the discount the real cash flows using the real discount rate. Okay, and if we are using the nominal cash flow, then we should use the nominal discount rate. Okay, NPV in both cases will remain the same. And very one important point, if there is inflation and for working capital there is separate inflation rate has been given, then you need to also incorporate this factor into your calculations as well. So it is one of the very important point. I think I should cover the same. And regarding the standard deviation, coefficient of variation, all these terms will also be again covered in the chapter on portfolio management, where okay, you mean to say, okay, decision is the same. Don't worry, maybe I have to speak on the decision will be the same. Okay, so there will be no change in the decision. Value will be the maybe differ, but decision will be the same. Okay, when we talk about the if we talk about the portfolio management topic that I was discussing, so these also will be there, because there the standard deviation is an indicator of the risk that will also be taken there. Only the difference is that there we shall consider the strokes return there. Okay, here we are considering that capital budgeting. Okay, so student, with this we come to the end of the session, and CA Jagbandhu ji will continue this assignment as well in the next class. So meanwhile, if you have any queries, okay, so you can send us. Jagbandhu ji, just write it on the iPad. I just share my number as well as my email ID. Just open one blank slide. Or yeah, just write down SFM dash final, small, everything is small, @ICAI.in. Okay, or just and write down also the phone number 0120 in the next 0120 dash 3045 956. Okay, student. So in case if you have any query, you can contact me over the telephone. Okay, I will attend your telephone, and you can send your email at this number. The same query will be forwarded to the CA Jagbandhu ji for the reply. Okay, Jagbandhu sir, thank you very much for sparing your precious time and enlightening the student on the same topic. Okay, student. Have a yes, please.
Yes.
Yes, sir. For disturbing, sir. Good morning, sir. Sir, I have one that how the real discount rate, the NPV calculated through the real discount rate and nominal discount rate is same.
Yeah. No,
First
actually,
question.
decision is same, beta. Decision
Sir,
shall
how?
see, Jagbandhu ji, let me show.
Yeah. Rachi, the decision is going to be same even if you discount the real cash flows with real rate or nominal cash flows with nominal rate. Right. So the final decision whether to accept the project or not, that's going to be same.
NPV positive na both cases. Negative or positive, whatever will be the same, it will be the same.
Yes, sir. But the calculation of the NPV is the 17,000 in case of the real return, or same in case of the nominal return. Then how it is same?
No, just take me that to the calculation. Okay.
Your cash flows are adjusted and also the discounting rate is accepted, na beta, Rachi? So when your cash flows are adjusted, discount the cash flows are higher in case of nominal rate. So discounting rate is also higher. So they both offset each other. And therefore, you get the NPV on the similar lines, because NPV, as the name says, it is present value. So both the numbers are giving you the net effect on present value. So therefore, your decision and the numbers are also going to be same. Obviously, when we take into account the impact of the non-inflation impact of depreciation, there the numbers will be different. There you cannot say that they are matching with each other.
Now here just show it, Jagbandhu ji, just show it. It is, you are showing 17,368.81. It is as per our real rate.
Yeah, and this is
as per nominal rate.
Nominal rate.
So both are the same.
There's just a difference of 0.02. That's because of rounding.
That's why NPV may be slightly different, but decision will remain same, na?
Yeah, decision will remain same. Yes.
Yeah, that's it, na? That's why the decision will remain same. So we cannot say exactly it will be same. There may be some difference in NPV, but the decision will remain the same. Okay,
Okay, sir. Thank you so much, sir.
Okay, student. With this, we come to the end of the session and revise what we have discussed in today's class, and in the next class we shall continue. Okay, Jagmandu ji, thank you very much.
Thank you, sir.
See you in the next class. Thank you.
Goodbye, friends. Bye-bye. See you soon. Bye-bye.
Yes.
Yes, sir.